Shares of India's Lupin in focus is 1 minute to go before the market comes online. So you're seeing the pre-open there for Lupin have about 0.6% this year. The stock has moved just about 2% in the green. This after the pharma major reported Q4 earnings. Revenues rose 14% from a year ago to 443 billion rupees. That's 44,300 crores. Really? No, that doesn't seem right. We need to work that around. Aided by API, US and Indian business growth. However, most of its revenue came from growth markets. Net profits in the fourth quarter stood at about 250 crores against a loss of 340 crores a year ago. Lupin also recommending a dividend of 4 rupees per share. Ramesh Swaminathan is Executive Director at Lupin and Global CFO of the business, joining us with his thoughts on the earnings. Ramesh, good to have you on the show. Thank you very much for your time. How would you reflect back the performance of the business this quarter?
Well, first of all, thank you for having us on. And welcome to a refreshing set of numbers. When we met a few quarters ago, we did speak about the fact that there'll be successive improvement in EBITDA over the next several quarters, and that is what we actually set about performing. If you look at, in fact, the cost lines, there has been tremendous leashing on rein on cost itself. We actually worked on several measures in terms of reducing costs. And that, in lots of ways, have been captured in the gross margin line. But unfortunately, there has been, of course, secular inflation that has run across all industries. And of course, our industry has also, it's not as though it's immune to that. And to that extent, the gross margins could have been better, but for this inflation factor, because optimization was certainly there across air freight, across write-offs, and in terms of returns and the like. This is also evident in other lines across the manufacturing, other expenses, so to speak. There's, of course, a lot of investments happening in India in particular, and adjacencies that we had actually started a few quarters ago. And to that extent, there is, of course, a slight increase. But this is, of course, in some ways offset by the various initiatives that we've taken on the cost front. So far as the top line is concerned, it does not move so much. That's because of the fact that we did not have the products to kind of launch. But as we said, we have, in fact, a cashier of products that we'd be launching in the next several quarters across markets, and in particular America. Spiriva, Darunavir, Varenicline are all of those products that we would be bringing to the market in the next several quarters.
Could you talk a little bit more about your U.S. drug pipeline and the regulatory environment, how supportive that is to generic drug pricing?
Yeah, I just spoke about it. So insofar as we are concerned, we believe that we have, in fact, a very robust pipeline for the U.S. In the current quarter, in the current year, for sure, we do believe that we would be launching Spiriva, Darunavir, Varenicline. But only a start. We are actually building up a pretty impressive portfolio when it comes to, in fact, complex products across inhalation space and injectables. And that is going to be the future. And some of these platforms would actually straddle across, would actually serve markets across other geographies, Europe and potentially Latin America and other parts as well. So we do expect all of this to click in and to get us back to, in fact, where we usually used to perform about 2-3 years ago in terms of EBITDA margins.
Why is the market not capturing that optimism, given that your business is not cyclical and in fact is defensive, so in many ways is immune to any sort of slowdown in your major markets like the US or Europe?
I would think that the market is kind of adopting a wait-and-see kind of an approach because, of course, there is risk in terms of, any of these products when it comes to, in fact, regulatory approvals and the like, and they would actually like to see the proof, before it kind of reacts. And that is what I think the market is currently factoring in.
Indeed, but there seems to be an underwhelming response, really, to pharma names in India. That's not been really the case for some of the US-listed names, so I wonder how that really works out. I do want to get your sense on the challenges that lie ahead. You spoke about, obviously, input costs. How much pricing power do you have in this environment to pass on those costs, especially in your key markets?
When you speak about headwinds in the sector, the generic sector is, of course, impacted tremendously by price erosion, especially in the key markets of America. So what was previously about $65 billion in terms of the overall size of the generic industry, it has kind of eroded to about $56 billion over 5 years. This is essentially because the fact that you found channel consolidation, and that actually meant that the manufacturers were at the receiving end. So prices eroded. Though not, of course, across the more complex ones or injectable space, where that's exactly where we are focusing on. So when the market is, apart from, of course, the systemic issues, we also had company-specific issues in terms of issues around OAI on factories and so on, which actually meant that even products that we had in the pipeline could not be launched out there. So all of this compounded into kind of weak performance, but I think we are getting over it. For insofar as, for example, the FDA-related issues of certain factories, we have come out of those. There are a few more to go, and we are focusing on all of that. Apart from, of course, the initiatives on the cost front, and apart from looking at, in fact, how do we move the top line across various markets. India region, of course, we had the issues around the loss of exclusivity for certain products. That eroded growth prospects for in the last few quarters. But all of this we have tackled, and we are hoping to steam ahead.
So then realistically, what sort of guidance would you work with as you start off the new financial year in terms of overall sales growth and profitability improvement, given all that you've said?
So as I said, so we are focusing on doing the right things when it comes to the top line and on the cost initiatives. So we do expect, in fact, the successive quarters to be better from a margins perspective, and that's been the case for the last 3 to 4 quarters. We expect the same kind of growth momentum to continue the quarters to come.
Could you quantify that growth momentum, Ramesh? Because I think it really boils down to numbers. If you're saying that a lot of the headwinds have been tackled, whether it's with the FDA giving clearance.
I'm saying that we are conscious of those, and we're working to overcoming a lot of those. By the end of the fiscal, we think that an EBITDA margin run rate of about 18.5% is well within reach.
And what would that mean in terms of revenue growth, especially from major markets like the US, which are right now, I think, 11% of your total revenue? Can you increase that?
We believe that the overall growth rate of the top line for the entire company would be in the high teens, between 12 to 15%. And we're working towards that. It obviously has an impact when it comes to the bottom line as well. Operating leverage would really click in, and that would mean better margins for us.
Well, we wish you the very best. It's a tough environment out there, especially for some of your key markets. But as a defensive business, maybe you can ride over it. Thank you very much for your time and your insights, and all the very best for the future, Ramesh.
Thank you very much.
Time now for a short break. But coming up, Indian markets have joined the trading day. Get you a quick check on the Mumbai action.